Hi, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and welcome back to The Pulse, where we take a month-to-month look at what happened in the economy and the capital markets so you make better decisions in your business and with your investments. Let's start with the highlights. May gave markets a relief rally, though the move was more sentiment-driven, and inflation is easing with the Fed still measured in its approach to lowering rates. Meanwhile, consumers are spending while their confidence and small business hiring plans weaken, and it's a mixed picture. Now, there are reasons to be optimistic while also having caution. Now, let's take a deeper look at the data, see what else we can learn. Stock markets have rebounded strongly in May from the April 2nd tariff announcements. U.S. and international equity markets are higher this month and quarter to date, leading U.S. markets to be marginally positive for this year, while international markets are up now 10 to 15%. The tech-focused NASDAQ and smaller company Russell 2000 are still in the red for the year. Now, the rally has been tough for safe haven bonds, such as government bonds and investment-grade bonds, as investors have sought more risk, yet they're still up year to date on concerns over uncertainty. Now, commodities have been more of a mixed picture, off this quarter on concerns over global demand if there's less trade, while Bitcoin has been a clear winner this quarter and for the year. Now, markets have bounced and valuations have snapped back, especially in tech, but most indexes are still trading below levels from early April. International markets, which are here in red and purple, remain lower than U.S. markets, and the lower valuations are one of the reasons that international markets have outperformed the U.S. this year. Now, just a few weeks ago, markets were pricing in 3, maybe 4 rate cuts this year. Now, one is expected in the fall and a second by the end of the year. There's less concern that the tariffs are going to lead to a recession, so the Fed wouldn't have to lower rates as aggressively. Now, another driver of expectations for Fed rate cuts is that inflation has come down. The Fed sees progress, but not fast or broad-based enough to justify a big policy pivot yet. Now, with that trend, core services inflation, which is here in gold, is what the Fed is watching most closely, and there's finally some movement there. Now, we're seeing real improvement in core services inflation, especially shelter, which is here in orange, and transportation in gold. And now these are two areas that were sticky for months. And within transportation, there's one specific driver that's making a big impact. Car insurance inflation, which is here in purple, had been running at over 15% year over year, and now it's closer to 2%. That alone is taking a major bite out of overall inflation rates. So the inflation story is improving. Now, despite disinflation and stable jobs, consumer sentiment has dropped to its lowest level since 1978. Now, people feel worse off, especially since the tariff announcements. And here's where the contradiction shows up. People feel bad, but they're still spending. And spending remains solid, especially in services like dining out and travel. It's as if people are saying, I feel terrible, but I'll still swipe the card. Now, we've highlighted this disconnect before as a key theme this cycle. What people say about how they feel and how they behave have been two very different things. Now, consumers are still going out, but the surge in restaurant spending is clearly cooling, and that kind of micro adjustment is what you'd expect from a consumer who's nervous but not broke. Now, the mood is shifting, and that matters for businesses on the margin. Not surprisingly, businesses are reconsidering growth plans. Small businesses have quickly changed their ideas on hiring. Now, coming into the year, there was excitement that 2025 would be a year of growth. From what's happened over the first 4 months, small businesses have quickly reversed course. Now, we see this in job posting data on Indeed.com. While the labor market has become more balanced the last few years, we saw a pickup in postings towards the end of last year over excitement about growth in 2025. But that's quickly reversed as the new administration has prioritized tariffs. To sum up everything from today, here are the key takeaways. May brought a welcome bounce in the markets, driven by improving sentiment. And inflation is heading in the right direction, and the Fed is watching it closely, but not rushing to reduce rates. And consumers are still spending, just a bit more carefully. And businesses are taking a thoughtful approach to hiring. All in, the economy is showing signs of stability, even if it's not running hot. Now with that, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and I'll see you next time on our next edition of The Pulse.